Now in this session, we are going to speak about a very interesting topic. The banks will continue to charge their interest and the customers have to pay back their loans with interest. Banks on the other side, let me now talk about the reward factor altogether. When you are going to use your credit card, when you are going to swipe your credit card for any of the purchase, you need to be very careful. What you have paid is what has been accepted by the bank. So that's well and good that you have done a great job. Good morning and welcome to the session 3 of Unit 2 in Management of Banking and Insurance Services. Now in this session, we are going to speak about a very interesting topic. In fact, a day-to-day matter called as the interest rate. Now everybody in this world is always worried about a factor called as interest. How much do you pay? How much do they charge you? And why does the concept of interest first of all occur in banking system? But then this is a very interesting topic. Why? Because this is the key concept for any bank today to understand its function, to understand how they lend and how they borrow altogether. So moving forward, let's try to understand the concept of interest rate today. Interest rate is the percentage of principal charged by the lender, that is by the bank, for the use of its money. And the principal is the amount of money that has been loaned. Now what is very interesting here is that each one of us in this world are in need of money. So there's going to be no doubts about it that, sir, I am already filled with money. Nobody is going to say that statement. Everybody needs money in different areas, in different quantities, in different angle or perspective altogether. So what happens in the long run is that people go and approach the bank asking for a loan. The moment when the loan is being presented to the customers, what comes really as a surprise to them is the interest rate. Because many people do not understand the concept of interest rate. They just believe that it is just a one-time factor or it is like for 1 year factor. But then interest is something that keeps on occurring with you. That's an inbuilt part of the lending system. So unless and until you are going to repay back the bank in full money, in full length and amount altogether, you are not going to go away from the interest at any given point of time. So interest is a very interesting factor. That's why I say that, because it has to be imbibed in each and every payment that you make. But then the interest rates will affect the cost of the loans as far as they result in the speed up or the slowdown of the economy. In the past 6 to 8 months, there have been several kind of moratorium and several kind of incentives, or rather I would say excuses, that have been given by the government in terms of helping the customers. But still then, the banks will continue to charge their interest and the customers have to pay back their loans with interest, which is making the scenario quite tough. That is why what happens here is that the concept of interest rate has to be understood from the point of economy rather than as an individual. Now for a person, interest rate is a burden, but for the bank, interest rate is a lifeline. Without the interest rate, without the factors moving in, they would not be able to run the bank smoothly. So the interest rate, if it is on the higher side altogether, that means the repayment capacity, the amount of inflow that is going to come back into the bank is also on the higher side. But if the lending rate starts on a declining note altogether, that means to say that the economy is not in a great shape. Why? Because nowadays what is happening is most of the people do not have money, do not have the affordability to repay back the loan. So automatically it starts going back in the reverse trend. So lesser the interest rate, all of a sudden what happens is that the amount that has to be collected by the bank also starts coming down. So nevertheless, the lending rate and the borrowing rate will be a matter of concern to every single bank in our country. Now moving forward, we're going to talk about what is exactly an interest rate. How are we going to describe it? How are we going to take it forward? Now, an interest rate is either the cost of borrowing money or the reward of saving it. Now, this is a very, very interesting concept. Let me just put you for a while here that example. If you have saved about, say, 1 crore rupees in your bank today, and you take this 1 crore rupee and you put it as a fixed deposit in your bank. Now, the bank promises that it will pay you 7% interest on that 1 crore. Now, wow, I am going to get 7 lakh rupees per year only as interest. Now, that 7 lakh is going to be divided by 12 months. So, I'm going to roughly get about 258,000 rupees a month. Now, how is that? Without doing anything, you are going to get back 58,000 rupees per month only as interest. Sounds exciting, sounds great, no doubt about it. But then what we are worried, what we are looking into here is that interest is a concept that is applied to both borrowing as well as for lending. So which means to say that for a customer standpoint, when he borrows a loan, he is going to pay interest on it. On the other side, the same customer, when he is going to deposit money into the bank, he is going to get in return the interest value. So interest is on both sides. It's on the saving side. It's also on the spending side. So you need to be alert. You need to be cautious to understand which side of the interest are you taking in from. But then coming back, it is calculated as a percentage of amount borrowed or saved. So in the case of amount borrowed, when you go to the bank and you say that, sir, I need 10 lakhs, I need 20 lakhs, I need 30 lakhs or 40 lakhs for an X purpose, might be for home loan, might be for car loan, might be for education, personal loan, whatever the factors, the interest is going to be charged on the entire amount, which is later going to get converted into equated monthly installments, or what we call it as the EMI concept altogether. So what is more interesting here that we need to understand is that the interest is going to be calculated for the entire amount. It is not going to be on a partly basis, or it is not going to be on the factor that, sir, out of the 10 lakhs I've used only 6 lakhs, for the next 4 lakhs you can't charge me. No, we are not going to do any division, any partition there. We are going to charge the interest for the full amount altogether. So that's why this is very, very important. Now, you can borrow money from the banks when you take out a home mortgage, or you can take other loans for buying a car or paying an education. That's what we were trying to understand as in the loan factor. Now, banks on the other side, let me now talk about the reward factor altogether. Every month, bank has an option where you can start a recurring deposit, you can do a fixed deposit, you can do something like a small time deposits altogether. Now, what happens, or what I call it as a short-term deposit altogether. Now, what happens in this entire cycle is that you will be paid an amount of interest for the amount that has been saved. So every month, if you're going to save 1,000 rupees or 10,000 rupees, for that amount, there is going to be an interest that is going to be added to the bank, added to the factor that's your account by the bank. Now, this is very, very important and interesting, which means to say that as a shrewd customer, as a clever customer, as a person who understands the banking scenario, the more you save, the more you get in terms of interest. Now, the major factor here is that the interest rate is not going to change, but the savings is definitely going to change. So the more you are able to save on that money, you are going to get interest, and the more you tend to borrow, for that money you are going to pay the interest. So in India, what we typically try to do here is that we first try to understand and calculate the necessity of borrowing, which means to say that bank first tries to assess a customer based on the requirements rather than just the amount altogether. So if I go to a bank and today say that, sir, I need 50 lakh rupees or 1 crore rupees for building a home, the bank is not just going to give back the amount to me saying that, yes, sir, it's readily available. Rather, the bank is going to think about my repayment capacity. The bank is going to think whether I am really capable enough of returning that money. So many questions are going to come into picture. Why? Because banks understand that there is going to be a huge amount of interest that is going to be added, and at the end of the day, the interest is also going to be calculated and you need to pay it back. So that's why whenever you are borrowing money, you need to be careful in terms of the interest. Now, when you are saving money, the banks will accept it in the form of term deposits. And what happens here is that the bank will definitely charge a higher interest when it is lending money to you, and bank will charge a lower interest when they are borrowing money from you. That's how they make profit altogether. Now, why is that coming in? So, for example, if they are giving out a vehicle loan for 12%, the amount that they will give you in terms of fixed deposit might be only 6%. The remaining 6% is where they are trying to make their profits. So nevertheless, what we need to understand here is that interest rates are not going to be stable. Interest rates are not going to be permanent always. Interest rates are going to be calculated on the amount, on the need, on the necessity, and the time taken by the customer in terms of repaying it back. Now, moving forward, how the interest rate is going to work, this is how it is going to work. Why? Because if I'm going to talk about the interest rate, I'm also going to talk about a very, very important factor called as the total unpaid portion altogether. Now, if you start looking here, interest is something that is really fascinating. Why? Because as you start understanding this session, you will feel that, sir, I am been constantly paying my loans on time. I am been constantly paying my EMIs on time, but still it is not getting down. I am paying the same amount again and again. When is the time or when is the day that will come where it will become complete zero? When is the day when I will get a nice message on my mobile phone stating that, yes, you have completed the loan, congratulations. But that's not going to be that easy. Why? Because you need to understand interest is going to be charged on the total unpaid portion of the loan or on the credit card balance. Now, interest is never ever going to be charged on what you have already paid. What you have paid is what has been accepted by the bank, so that's well and good that you have done a great job. But then whatever is remaining in terms of your unpaid balance, that's what you are going to be charged for. So unless and until you clear up the balance, you completely pay out the loan, you are not going to stop there at all. It is going to be a continuous process. So for example, if I say that, sir, I'm going to take a loan for 5 years, that's going to be 60 months installment. Until that 60 months gets completed, the EMI is going to come as a repeated message in your mobile phone. So that is what is very, very interesting for all of us to understand and to know here. Following by which, although the interest rates are very, very competitive, they aren't the same. That's another point which I want to talk with you. Now, when I'm going to talk about this competitive interest rate, that means to say that every bank has a competition internally and externally. Though banks might belong to the same group, though banks might be of the same factors altogether, they are in the same vertical, they are in the same industry, they are governed by the same regulator called as the RBI, the Reserve Bank of India, but everybody is not going to be on the same page. Everybody will try to compete against each other, trying to say on this factor that yes, they need something more than the other. That means they need to be better than the others, they need to be competitive enough. Now, SBI might give you at a cheaper rate of interest when compared to Yes Bank, then HDFC might give you a better rate than ICICI, IDBI might give you a better rate than the Canara Bank altogether. But what is trying to happen here is that A versus B is always a competition here in terms of the banking industry. Why does this happen is that the bank feels that somewhere they need to do a balance, they need to bring in a stability, a strike in such a manner that the customer is able to get the best of the needs, and at the same time the bank is also able to make a better profit altogether. So what happens here is that now for a bank will charge a higher rate of interest if there is a lower chance the debt will get repaid. Now this is where another clause comes into picture. Now what I tend to do is that I understand from your credit history that you are not good in terms of repaying back your loan. So for a banker, he understands the chances of this debt becoming a bad debt is on the higher side. So what do I do immediately? I will start charging higher rate of interest. I will go back and I say that the loan which is available for 14%, I'm going to give you for 16%, which means I am going to increase the rate of interest. Why? Because I understand it very, very clearly here that the chances of getting back the money is rare. So let me charge on the higher side. Let me try to recover as far as possible from my side. So that is where we get into this picture altogether. Now, the other thing is that we will tend to assign a higher rate of interest for revolving loans such as credit cards, and these types of loans are more expensive than the normal loans altogether. Now, that is also quite important for all of us to understand here. Why? Because moment you swipe your credit card, you take the money out and you go out, there is going to be a revolving exercise that comes into picture. That means there's going to be a rotational credit that comes into picture. Many of us believe that, just swiping the credit card and after 45 days, I can just repay back the money. Now, that's a quite good idea, or probably, at that spur of the moment, it feels really good. Why? Because somebody is giving you credit for free. But then that is not true. What happens at the end of 45 days is that you are going to be charged for the money that you have already taken. And that money and the interest that's going to be paid for it is going to be quite huge. So what we need to be cautious here as a customer is that when you are going to use your credit card, when you are going to swipe your credit card for any of the purchase, you need to be very, very careful that are you in a position to repay it back at the least term as far as possible. The more you delay, the more you prolong, automatically there is going to be a huge amount of credit charges that are going to be added to your account. So this makes the entire factor even more challenging altogether. So that is why I always say that whenever you are using your credit card, you need to be careful. Followed by the higher your credit score, the lower is the interest rate that you have to pay. Now that is a silver lining in the cloud, what I would like to say. Why? Because if you have a higher credit score, suddenly you see that you have been able to repay back all your loans, you've been maintaining a fantastic credit card score, you suddenly see that you are a 900 or 1000 of 1000 in terms of your credit code, that's your CIBIL or your Experian and other kinds of credit rating agency. Now what is the reward that is waiting for you? You are going to get a personal loan at a very, very cheaper rate as far as possible. Why? Because your credit history is going to tell the bank that you have been doing a fantastic job in terms of returning the money on time. So on the basis of this, the bank is going to now extend an offer to you which is going to be at a cheaper rate of interest when compared to any other situation or any other customers altogether. Now that is why you need to know how does the interest come into picture. So interest is not going to be a stagnant story. Interest is going to be a fluctuating theory that is going to change according to the person, according to the need, and according to the time that is taken altogether. Now, moving forward, we are going to talk about the fixed versus the variable interest rate. Now, what is the fixed and what's a variable altogether? The words might be very, very easy for us as I talk apparently, but then when I say there is a fixed interest, that means there is a fixed charge or a variable rate altogether. Two types of factor that we are going to talk about. Now, what do you mean by fixed charge? Throughout your lifetime, throughout the lifetime of the loan, the bank is going to charge one single rate of interest. Now, I'm not going to increase it. I'm not going to decrease it. Whatever might be the condition, I am going to give you that particular loan at a fixed rate of interest. No changes at all whatsoever. That means to say that, yes, I'm going to run on the same money, same EMI altogether. So which means I can pretty much fix my mind and I say that every month the EMI would be 5,000 rupees. I'm not going to change on my EMI at any given point of time until that loan gets completely over. So if the loan is for 1 year, for 2 years or 3 years, I'm going to pay the same amount as EMI because my interest factors are fixed. So with pretty much the amount, the outcome is also fixed. But then when I move towards the variable rate of interest, that will change with the prime rate, which means to say with the lending rate, with the scenario, it will change. Now what is happening here in the variable rate is that when the rate rises, so will be the payment on your loan. Now comes the clause factor. Suppose the interest rate starts going up. This is where I bring in the word called as floating rate of interest. Where will you find this floating rate of interest? The floating rate of interest is one interesting concept that you can see in home loans or you can see in any long-term loans altogether. Now, when you're taking a floating rate of interest, you need to be careful. Why? Because if there is a fluctuation in the economy and the interest rates are hiked, as given by the direction of RBI, then automatically your payment will also go up, which means you need to be ready to shell out more money than what you were doing in the previous month. So this is going to be a challenging factor for you. So floating rate will show that there is an amount of wavering that will start coming based on the prime lending rate. And with these loans, you must pay attention to the prime rate. That's what I've been saying. Why? Because as the economy is going to go up, it's going to show a shoot altogether. In terms of moving forward, this will be a question mark altogether. With either type of loan, you can generally make an extra payment at any point towards the principal so that you can pay the debt off earlier. And that is going to be quite tricky and that's going to be quite challenging. Why I say that? Because moment you start getting into the habit of paying something extra, that means you will be getting onto the loan where you're trying to stress yourself to pay more. But nevertheless, you need to understand this factor. The more you start paying towards the loan, that is more than the prescribed amount of the EMI, that means your debt can get over faster and you can come out of the loan as early as possible. Moving forward, how are the interest rate determined? Now, who is determining this interest rate? I really want to know. Why? Because I can go and ask this person to fix it at a lower rate. But then that's not going to be the scenario here. The scenario here is that the interest rate is being preserved by the RBI. That's why I say the Reserve Bank of India with the treasury yield notes, whatever is that, or the Fed rate funds altogether, the federal factors here. So RBI is going to come into picture and RBI is going to find out the rate of interest for everything, that is including the lending rate, the borrowing rate when it concerned with the India. Now, according to the Indian government, according to the Indian scenario altogether, RBI will decide the demand and the consumption factors that are happening in our economy. Many a times what happens is that the economy might be healthy, but people are not ready to borrow or people are not ready to move further. There might be a situation where people are good, things are moving forward, but then I am not able to do anything really on the way. So what is going to happen is that RBI will now decide, depending on the borrowing, depending on the liquidity, depending on the scenario of how much can a bank go in terms of lending and in terms of borrowing. Now, impact of high versus the low interest rate. Now, what is going to be a high interest rate altogether? High interest rate will make the loan more expensive. Point taken. Why? Because if I'm going to charge you 16%, 18% on a similar kind of loan, like an education loan or on a vehicle loan or a home loan, it is going to make the customer repay back on a higher note. So it is going to be really expensive. Now, that is a very, very important factor. The second thing is that when interest rates are higher, fewer people in business can afford to borrow. So which means to say that for the banks, they might lose out on customers. Now, for a banking sector, for a banking scenario, lower the interest rate, they will be able to attract those mass customers, those hundreds and thousands of people living in India who are in search of those small-time loans. But moment the bank starts flashing a higher rate of interest, a higher interest card altogether, the customers will go back saying that, sir, I am not in a position right now to afford these kind of loans, so I might not be the right customer. So this is where the higher rate rate of interest will definitely have an impact towards the revenue of the bank. The second thing is that when you have an interest on a lower side, automatically the credit facility is available. Many people will jump the bandwagon of taking loans from the bank, which in turn increases the revenue of the bank. Followed by, it also encourages more people to save because of the higher received amount in terms of savings. Now, this is another factor that we have to talk about. Higher the interest rate in terms of lending, that is in terms of loan, that means people will not go and start borrowing loans. On the other side, they will start saving. Why? Because if the bank is going to lend at a higher rate of interest, the bank is also going to give a better rate of interest in borrowing, which means the fixed rate of the deposit rate will also go up. So this is the right time for me to save more money and earn more interest from my savings account. So what customers will tend to do here is that they will start saving more and more money so that they are able to get a better rate of interest. Now, the other factor is that higher rates of interest would reduce the capital available to expand the business, thereby shrinking down the supply altogether. This reduction in liquidity slows the economy. Now, for every single economy in this world, liquidity is a matter of high importance. So automatically, if the liquidity comes down in the economy, we are not going to survive at all. It becomes quite difficult for us to push forward and do business. So that's why higher rate of interest is always not really acceptable. Lower rate of interest means that yes, we will be getting a liquid money flow in the system, and automatically you will be able to see a better growth, a better scenario, better economic development. Now, lower rate of interest will have an opposite effect, and what is going to happen here is that low mortgage rate will have a same effect falling down. So people will borrow more money, more fluctuation, more movement in the economy, the liquidity will start flowing up. When savers find that they get less rate of interest on the deposit, they might decide to spend the same money. They might go out, take the money out of their savings, and they will start spending it. So right now in India, this is a current scenario which I'm trying to explain. If you see that most of the banks are offering a very, very less rate of interest for fixed deposit, plus they've also made the loans very, very attractive. It would not be a surprise for you that if you have been receiving regular emails and messages on your mobile phone or on your email account saying that low rate interest loans are available for your personal usage or for any other purpose. This is because government now wants the economy to push up, to revive back altogether, and the only way of reviving is that you start spending more money, you start increasing the demand, you start increasing the consumption factor altogether. So that's how the impact is going to be in terms of a high interest rate versus the low interest rate. Now with this, I come to the conclusion of this session. I hope and believe that this session was highly interesting, useful, and in terms of resource altogether. Now, in the next session, we are going to talk about some more interesting factors in the banking scenario, and we are going to talk about a very, very important concept called as the Banking Regulation Act of 1949, and that's how the banks got regulated and they came into picture for the Indian economy. So until then, stay tuned, stay blessed, and stay enlightened forever. Thank you once again for joining me on this wonderful session.